We can think of the yield to maturity, or say the return of our bond investment, as the sum of two components, current yield and capital gain yield. Current yield is the annual coupon payment amount divided by the price. So current yield looks at the current price of the bond and represents the return an investor would expect from the coupon payment if he or she purchased the bond at the current price. This actually is not an accurate reflection of the actual return that investor would receive in all cases, because bond prices are constantly changing due to market factors. To reflect the return due to the change in bond price, we have the capital gain yield. The capital gain yield is the capital gain, which is the change in price, divided by the beginning price. The expected total return from the bond investment, which is the yield to maturity, equals to the expected current yield plus the expected capital gain yield. So for example, for a 9% coupon 10-year bond, the price is $8.87, yield to maturity is 10.91%. We can calculate the current yield, which is the coupon payment divided by the price, so that's about 10.15%. Then we can see the capital gain yield is the difference between the yield to maturity and the current yield, so that is 0.76%. That gives you the idea that the bond price is expected to rise a little bit, not much, but 0.76% over the next year. You can also calculate this capital gain yield by calculating the bond price in year 1 and find out the difference between bond price in year 0 and year 1 and divide this difference by the price in year 0, which is the $8.87. So then you will get the same answer, which is 0.76%. We'll take a look at example 5-10 at the end of chapter 5. This is page 227 in your textbook. The Brownstone Corp's bond have 5 years remaining maturity. Interest is paid annually, and the bond has a 1,000 par value, and the coupon interest rate is 9%. So the question is, what is the yield to maturity at the current price of $8.29 or $11.04? So we'll take a look at the case at the yield to maturity when the price is $8.29 first. When the price is $8.29, we can input into your financial calculator 5 as N, price as a negative $8.29, and a payment of $90 per year, and future value 1,000. We can compute IY, and you get IY result as 13.98. So that means the yield to maturity is 13.98%. Then when the price is $11.04, you just change the PV from negative $8.29 to negative $11.04. You compute IY, and you get IY as 6.5. So that is a year to maturity of 6.5%. Part B of this question says, would you pay $8.29 for the bond if you thought that the appropriate rate of interest was 12%? So the answer is yes, because at a price of $8.29, the yield to maturity is 13.98%. And this is greater than your required rate of return of 12%. Let's also add a part C, which is not in your book. What is the current yield of the bond if the price is $8.29? We can calculate the current yield as a coupon payment amount divided by the current price, so that's 90 divided by $8.29, so that's 10.86%. So again, current yield measures the return from coupon payment, but this is not a comprehensive measure about the annual return from the bond investment because it does not account for the potential increase or decrease in the bond price. So far we talked about price and yield to maturity for annual coupon bonds. In reality, actually most of the bonds pay their coupon payment semi-annually. So for semi-annual coupon bonds, we only need to make some simple adjustments. We multiply the years by 2 to get the number of payments. So 2 multiplied by n. That's how many coupon payments you are getting in all those years. And then you divide the nominal interest rate by 2 to get the semi-annual interest rate. And you divide the annual coupon payment by 2 to get the semi-annual payment. So your annual coupon rates multiplied by 1,000 and then divided by 2, you get the coupon payment amount every 6 months. Your future value amount, that is the $1,000 par value payment, and this will not change. And then you compute for the price, the present value. So for example, if we want to calculate the value of a 10-year 10% coupon semi-annual bond, if the discount rate is 13%, then 10-year, that means 20 coupon payments because there are 2 payments each year. Each payment is $50, which is 1,000 multiplied by 10% and then divided by 2. Future value remains 1,000. And here, for the semi-annual interest rate, you're using 13 divided by 2, so 6.5 as IY. You compute for the price, for the present value, 834.72. Now, let me show you in Excel how to use the PV function to compute the bond price. So, for example, if we are looking at a bond with 10-year maturity and 13% coupon rate, and a par value of 1,000. So I simply type in equals to PV, and our rate is 10%, and 10 payments, each payment being 130, and our future value, or say the final par value, is 1,000. So the price is 1184.34. And another way in Excel is to look it up from the formulas, search for the function library, and here type in PV from all formulas. So we search for the PV function, and this is what we find. And then we just start typing in a rate of 10%, 10 payments, each payment with 130. Future value is 1,000. And you can ignore the type and simply say OK. And the result is also 1184.34. So you can use the built-in functions from the function library and look for the PV functions. If you check out the Excel file that I posted on D2L, which is the Chapter 5 mini case Excel, you can also find details in bond valuation with Excel. Recall that a callable bond is a bond that gives the issuer right to call back the bond before the bond matures. So if it happens, then the investors cannot hold the bond till maturity. And that's why we need to calculate the so-called yield to call. So for example, if we have a 10-year 10% semi-annual coupon bond with $1,000 par value, and is currently selling for $1135.90 and 9% yield to maturity. So that is if you can hold the bond for 10 years till maturity. But it can be called after 5 years at a call price of $10.50. So what is it yield to call? We can calculate the yield to call the same way as the yield to maturity. So with the help of the financial calculator, we have coupon payment $50, and we have 10 SM because that's 5 years, or say 10 coupon payments. So this is if the bond is called back in 5 years. So within the 5 years, 10 payments, each payment being $50, and when the bond is called back, the company, or say the issuer, pays a call price of $10.50. So FV here is not the $1,000 par value. And the price is 1135.9 in the negative number. And we compute for the IY, and it turns out to be 3.765. And notice this is for 6 months because this is a semi-annual coupon bond. So for the whole year, the yield to call is 3.765% multiplied by 2, so that is 7.53%. And notice this number is lower than the 8% yield to maturity. That means if the company, the issuer decides to call back the bond, then the investors, the bondholders, cannot realize the yield to maturity. Instead, they would only realize the yield to call. So if you are an investor and you bought the bond would you be more likely to earn a yield to maturity or yield to call? For this bond, notice that the coupon rate is 10%, yield to call is 7.53%. The 7.53% yield to call suggests that the company could raise money by selling new bonds which pay 7.53%, a lower interest rate. Therefore, the company is likely to call the bonds and replace them with new bonds that pays only $75.30 a year, therefore reduce their interest expense. And this also means that investors should expect a call and expect that they can only earn the yield to call 7.5% for 5 years, not the yield to maturity, which is 8% per year for 10 years. In general, if a bond sells at a premium, then the coupon interest rate is greater than the market interest rate, so a call is likely. And investors should expect to earn a yield to call on premium bonds and a yield to maturity on bonds that are traded at par or at discount. So far we have talked about the fact that bond price or bond value is negatively affected by the market interest rate. Higher interest rate, low price, and lower market interest rate, higher bond price. So what determines the market interest rate? Here we say that the interest rate that a borrower needs to pay is determined by these 5 factors. They are R star, the real risk-free rate, IP, the inflation premium, DRP, the default risk premium, LP, liquidity premium, and MRP, the maturity risk premium. So let's explain one by one. The risk-free rate represents the interest rate an investor would expect from an absolutely risk-free investment over a specified period of time. The real risk-free rate R star is the minimum return an investor requires. It does not take into account expected inflation. The nominal risk-free rate is simply the real risk-free rate adjusted for inflation. So we say the nominal risk-free rate equals to 1 plus the real risk-free rate multiplied by 1 plus the inflation premium and then minus 1, and approximately it equals to R star, the real risk-free rate plus the inflation premium. The nominal risk-free rate can be measured by the yield on Treasury securities. So if you click on this link, we can go find the 5-year Treasury bond yield. For example, the 5-year Treasury bond yield as of today is around 1.48%. So this is again the Treasury bond yield. And if you click on this link, you can find the yield on Treasury inflation protected securities, and we use that yield to measure the real risk-free rate. So 5-year TIPS rate is about 0.37. This is lower than the Treasury bond, 5-year Treasury bond yield. So the difference between the yield on the 5-year Treasury bond and the 5-year TIPS bond would indicate the expected annual inflation for the next 5 years. And that is the so-called inflation premium. A bond spread is the difference between a corporate bond's yield and the Treasury securities yield of the same maturity. Generally, this difference is caused by the default risk premium and liquidity premium that applies to corporate bonds. Remember, we said Treasury bonds are considered the safest investment and therefore risk-free. And Treasury bonds usually do not have liquidity problems, so liquidity premium for them is also 0. But for a corporate bond, because of the default risk and lower liquidity compared to Treasury bonds, we assign default risk premium to a corporate bond and the liquidity premium to a corporate bond. So the difference between so for example, the difference between a 5-year corporate bond and a 5-year Treasury bond, the spread is because of the default risk premium and liquidity premium for the 5-year corporate bond. If you look at the green curve here, this is the yield of AT&T bonds of different maturity. And as you know, AT&T bonds, they are corporate bonds. And the blue curve here, this is the yield of Treasury bond of different maturities. So for example, when you look at 15-year bonds here, this is the yield for a 15-year AT&T bond, and this is the yield of a 15-year Treasury bond. And the difference is called the spread here. Liquidity premium is a premium that investors will require when bonds cannot be easily converted into cash at the fair market value. Bonds of large, strong companies usually have very small liquidity premiums, but bonds of small companies usually have liquidity premiums as high as 2%. Default risk premium is the additional return or premium that investors would require to compensate them for taking additional default risk. Standard measurement tools to gauge default risk include credit ratings for bonds. Credit ratings for debt issues are provided by rating agencies such as Standard & Poor's, Moody's, and Fitch Ratings. Remember, at the beginning of this chapter, we look at the information for that bond issued by AT&T, and the Fitch rating for that bond is A. So that is the credit rating issued by Fitch Ratings that tells you the AT&T bond is fairly safe. Bottom line is that the lower liquidity a bond has or higher default risk it has, the higher premium will be charged by investors and the higher interest rate that issuer needs to pay. So this is a list of the factors that could affect default risk and bond ratings. They include financial ratios, so you can imagine higher debt ratio, then maybe higher risk, therefore lower rating. Provisions in the bond contract. So, for example, if the bond is unsecured, then it's considered to have higher risk and therefore lower ratings. And other factors, for example, the company's earnings stability and potential product liability, they affect the company's profit and earnings. So these factors affect the issuer's ability to pay back the debt in the future. Therefore, they affect the issuer's default risk and bond ratings. Maturity risk premium is a premium investors would require to hold bonds with longer maturities. And this premium exists because bonds with longer maturity have the higher interest rate risk. So what is the interest rate risk? For example, assume that there are two bonds. Both have 10% coupon, but one has 1 year maturity and the other has 10-year maturity. Now, if the interest rate rises from 10% to 15%, how would the price of each bond change? What if the interest rate drops from 10% to 5%? You can calculate the price of each bond under each different interest rate and find out. And so I put the result in this table, and for the 1 year bond, when the interest rate is 10%, which is the same as a coupon interest rate, this bond is traded at par. When the interest rate goes up to 5%, bond price drops, and for this 1 year bond, the price dropped to $9.57. So this is a negative 4.3% change. And when the interest rate goes down to 5%, bond price actually will rise, and it rises to 10.48, so that is a 4.8% change for this 1 year bond. However, when you look at a 10-year bond, again, when the interest rate is 10%, this bond is traded at par because it's the same as the coupon interest rate. However, when the interest rate goes up to 15%, the bond price changes to $7.49, and that is a 35% drop. Now, if the interest rate goes down to 5%, the price goes up, and it goes up by 38%. So if you compare the 1 year bond and the 10-year bond, you realize the price of the 10-year bond reacts to the change of interest rate more dramatically. So it is clear from the calculations that the 10-year bond experiences more volatile price changes but interest rate changes, and we call this higher interest rate risk. Bonds are also subject to the reinvestment rate risk. Cash flows from the bond will have to be reinvested in the future at lower rate, reducing income. So suppose you just won $500,000 playing the lottery. You will invest the money and live off the interest. You buy a 1 year bond with a year to maturity of 10%. In year 1, your income is $50,000, which is 10% of your investment. At year end, the bond matures and you get back all the $500,000 to reinvest. If interest rate falls to 3%, then the income will drop from $50,000 to $15,000. However, had you bought a 30-year bond, income will have remained constant. Therefore, if interest rate drops, short-term bonds have lower interest rate risk, but they can be more prone to the reinvestment rate risk because of the fact that you will have to take your investment back and reinvest the money. So, to summarize, for the long-term bonds, they have high interest rate risk but low reinvestment risk. For the short-term bonds, they have low interest rate risk but high reinvestment rate risk, and nothing is riskless. Generally, yields on long-term bonds are greater than short-term bonds, so the MRP is more affected by interest rate risk than by reinvestment rate risk. Bottom line is, longer-term bonds will have a higher maturity risk premium. So as a summary, after introducing bonds, we apply the time value of money concept and techniques that we have learned in Lesson 4 in bond valuation. So bond value essentially is the present value of an annuity. And we can use different approaches to get the results. We can use a formula, we can use a financial calculator, or we can use Excel. Annual return from the bond is called yield to maturity, and yield to maturity has two components, current yield and capital gain yield. For callable bonds, investors may only earn yield to call if the bond is called, not yield to maturity. Different bond issues are subject to different interest rates. The market interest rates are determined by factors such as risk-free rate, inflation premium, liquidity premium, default risk premium, and maturity risk premium.